Hey everybody, I'm John VanDuzer, CPA and partner with James Moore and Company, and I'm here with Kevin Golden, director and CPA with James Moore and Company, and we're part of the real estate services team. And we're going to talk about some year-end tax planning for real estate professionals. And so I thought the first topic that would be a good topic to talk about is retirement plans. I think this is one of our go-to strategies, and really I love it because it's one of the few places in the tax code that you can basically get a deduction and keep your money. So with that, Kevin, why don't you give us kind of a quick overview of the retirement plan options and especially as we were looking at year end?
Sure. No, thanks, John. And John's absolutely right. Retirement plans are a great way to not only save for the future, but to also save some tax dollars along the way. As a business owner and in real estate operators, a lot of the most common types of plans we see are what we call SEP IRA plans or solo 401k plans. There are definitely other options as well, but these are probably the two of the most common. In those, they both are easy to administer. They're both easy to deal with each year. They usually do not have their own separate tax return filing requirement. So for those reasons, they make them very popular. Also, they allow you to stick away a good bit of money in a SEP IRA. You can defer about 20-25% of your income up to about 57,000. Along the solo 401k option allows for even a greater deferral of about 20,000 for an employee. If you're over 50, that's going to bump that up by about another $6,500, and then even more depending on the amount of earned income you have for the year as an employer. So solo 401k plan does allow for even greater amount of deferral. The catch there is that solo 401ks, as they say, they're by yourself. You have no other employees, where a SEP IRA, you have to have, you can incorporate other employees as well. But both plans can be set up between now and the end of the year. And even further, a SEP IRA, you can wait all the way until you file your tax return next year to set that plan up. So a lot of flexibility on what you can do here at year end. Now, John, didn't you have some clients or some examples of people who implemented a retirement plan recently?
I did. So one of the big catches on the retirement plans is you have to have ordinary income. So it has to either be, fee driven of some sort, like consulting fees, management fees, some sort of fee. But I had a client that did have a separate S corporation where he generated consulting income and other fees. And so what we were able to do was set up a solo 401k plan. So he didn't have any employees. He was paying himself payroll anyway to comply with the S corporation rules. And so we were able to shelter some of those W-2 wages that he was required to pay himself with a solo 401k contribution. And then on top of that, you get a company matching up to the amount of your wages. So it ended up being a really quick pickup on deductions because we were able to shelter some of those commissions and management fees along the way instead of recognizing them. And so it became a good way for him to, save taxes and then continue to build his net worth. So it was a good deal all around. So I think that's kind of all we had on retirement plans, but keep watching our videos. The next video we're going to do is on the basis of accounting cash basis and how you can speed up or slow down deductions based on your taxes. So catch us next time. Thanks.